Hello everyone, welcome to our YouTube channel, and in this video I will be talking about a very less common known strategy known as short put ladder. Um, so if you have not watched my video on the back spread, call back spread strategy, please do watch that. It's a very similar strategy on this. Um, as before I begin today's video, I would like to inform you that whenever you sell option, even one lot of options, um, your margin would be around, you would require around the margin of the future. But when you hedge it with a buy position, then the margin requirement might reduce depending on your broker. All right, so let's begin. So call back spread strategy or put back spread strategy is very similar to this particular strategy known as short put ladder, and I think there is something called short call ladder too. I'm guessing. Um, yeah, short call ladder. So so this is an unlimited profit and limited risk strategy in options trading, and that is employed when the options trader thinks that the underlying strategy will experience great volatility in the near term. So if you are expecting a volatility and you are slightly bearish, then this strategy can actually do very well for you. So the construction of the strategy is sell ITM put, buy at the money put, and buy OTM put. Now the difference between from the call back spread strategy is these two. The buy options are, we are not buying two options here, and rather than buying one ATM and one OTM. So let me take you to the options chain here and tell you exactly how it will look like here. So I'll tell you on the put side, because I'm explaining short put. Short call is exactly the opposite, which is done on the call side. So in this strategy, you are actually slightly bearish, but you are expecting a major movement. But if it goes the other way around, you also your risk is actually defined. So so this is the option chain for Nifty here, and so you can actually buy 10,800 is where the Nifty closed. So in the money, I would say 10, 850 and 900. So I'm just going to take the in the money, which is 100.78, 10,900. We'll have to sell this put option and buy this ATM option. This is 10,800, and slightly out of the money, you can actually buy this 10,700. So 100 plus 166 would be your total buy price, and your sell price would be around 146. So you're taking a risk. If market goes down, or if it crashes, there is an unlimited profit potential, because if it crashes till here, this will be in profit and this will be in profit. This sold options would be in loss. However, these two will cover up for those losses, and you will be in good profit. So that's about this particular strategy. In call back ratio spread. Back ratio spread, you basically create two quantities here itself or here itself. So it's a very similar strategy, but here your risk defined is probably, the risk defined can be controlled through different ways. If the strike price selection is different, then you can actually control these losses. So again, I try to read more on these kind of strategies, since I like to be to see how the numbers go and things like that. A technical analyst may not like some of my strategies, or may not want to get into these strategies because of his own views and things like that. So I personally look at the mathematics point of view and see where exactly you can define risk and make money through simple strategies without even looking at complicated charts, and trying to understand the prediction of trying to predict the direction of the market. So in this strategy, as I told, this is where you should sell, or you can actually sell below 2. and then at the money 1 at the money, and then 2. So what is going to happen is you have sold only one lot of options, and you have actually bought two lot, one here and one here, somewhere here or somewhere there. So what if it market crashes still here? So please do understand that these two will be in very good profit, and we might the value of that would have been increased, but the value of this will go in one direction only, because you have only one lot which you have sold. So what will happen is this and this will give you good returns. This will give you less loss, or will give you loss, but the profits will be more than the losses. So in this way, you can take advantage. Now, you might ask me whether you can create on both sides. Yes, absolutely. If you have margin to take positions on the call side also, you can take call sides also. Now, what the big advantage over straddles, which this strategy gives you, is you actually in one side movement there your risk is actually defined, yes, and I personally think that you would be able to make more profits in this strategy than a long straddle. If you have not watched my video on long straddle, please do watch. That is where you actually buy call and put of the same underlying strike price. Okay, so in this strategy also helps in a range bound market, when the market is in a range and then it takes direction. So in this way, what will happen is that the premiums will be decayed here, so you would lose less than actually in a straddle. So again, straddle, you have to understand it differently. I'm not going to talk about it here. And it's nothing but long straddle means that you're buying and selling of the same strike price. But here you're actually defining the risk by selling one and then buying two. So one direction, there is a very good upside or downside movement, you can actually get good profits here. Short put ladder. So same way, call put ladder also works in the same way, where you actually selling one in the money call and buying one at the money call and one out of the money put. So again, the risk is actually limited. So limited, unlimited. So the maximum profit can be, as you can read it here, is unlimited, and and limited upside profit potential. So if it goes upside also, then you can there is a limited upside profit potential, but then there could be a limited risk also. If the market is in range bound and it remains in the same. So for example here, if the market expires in this range only, 700 to 900, which is a little unlikely, but if it closes here between these range only, you would have a limited risk, because this would be still in the money, and this will one of them might be still out of the money, and that's when you would have limited loss. One will expire worthless, one will expire in the money or still at the money. So again, at the money and out of the money will expire worthless. You would, again, theoretically, that's how a software will calculate it, but with human eyes, with your own calculations, you would know that where exactly you have to book your profits. Now, I would create more videos on booking your profits, because that's a very important lesson which every trader should know it. Many people do not book their profits on time and try to wait till expiry, and that's not a very good option in any kind of market, because even though you are expecting your profit potential is something like you have a target and stop loss in mind, and if you are waiting for another target, or second or third target, which you were not even expecting when you took the position, then that's a problem with your trading discipline, because you are expecting a stop loss or a target, and when one hits, you exit the position itself. Rather than that, you do not wait for whenever you see profit on the table, which is good for you, please go ahead and book it, and then you based on the market conditions, you can actually take up another position. That's another thing altogether. So that's about short put ladder. Hope you understood it. If it is still not clear, feel free to comment on this video, and I'll be happy to answer your questions and clarify your doubts. And so it would be good if you put down your questions as to what you didn't understand. In that way, I'll be able to answer them. So thank you. And if you have not joined my Telegram channel, feel free to join. It's a free Telegram channel where I post live market updates, and also you can contact me directly there too. So thank you, and I will see you again on my next video.